Now, this is kind of the lead up to our system of debits and credits. Uh, this system that we're using is called a double entry system. And this system is not obvious that it works, but it is like technology, I would say. It is a true like business technology. Whoever came up with this system was like, seeing the matrix. Okay, the fact that, and you're gonna see like you will have 1,000 transactions. You're going to use this system of debits and credits. And if you follow the system, at the end, the accounting equation will balance. It's freaking amazing that it works. Okay. So it was independently kind of came up with in different, there's different flavors of it, but, Italian merchants in the 1500s, when India and the British were trading a lot, they had devised some system in the 1700s. The Middle East, Korea, in the regions that had a lot of trade independently have kind of come up with a similar system of double entry bookkeeping because it makes tracking transactions and account balances just like so much easier. Okay. And you didn't really need a computer. Um, this is all in like ledger, people would like write stuff out and like keep columns and you'll see how we're going to organize it, but it was really a system where you could keep your accounting books organized and in kind of like a coherent manner. Okay. Um, there are uh, there are these cardinal rules. Okay, that you have to. These are something that you have to keep in mind at all times. You will eventually kind of take it for granted, but I think it's really important to make explicitly clear what these cardinal rules are. Number one, in every transaction, there are at least two accounts involved. There can be more than two accounts, but there's never less than two. This is why it's called double entry. Okay. Every transaction has at least two accounts. So what is some examples? We talked about when you're issuing stock to your investors. What are the accounts involved? One is cash because the investor is giving the company cash. What are they getting in exchange? Common stock. So there's two accounts involved, common stock and cash. When you perform a service for your customer, service revenue, and let's say they're going to pay you later, account receivable, right? There will never be a transaction that only affects one account. Okay, it will be two and sometimes many. We're going to see when we do like payroll, for example, there's going to be like 8 different accounts that we're going to have in one transaction. Okay, but there will always be at least two. Okay, the other cardinal axiom of this system is that your debits will always equal your credits, and we're gonna see, this. It's gonna make more sense when we kind of build the system out. But you can never have a transaction that where the debits and the credits are unequal. Okay, so maybe you're gonna have one account that's debited and 3 accounts that are credited, but the total debits and the total credits must always be equal for every transaction. And if you follow that cardinal rule, the crazy thing about this system is that at the end, your assets will equal your liabilities plus equity. And it's not obvious, but it's like if you get each little part right, the whole balances. And it's quite amazing that it works. Okay. Um, these words, debit and credit, are totally arbitrary. We could make them left and right, and this system would still work. Okay. So there's no inherent meaning behind debit or credit. They literally kind of just do mean left and right. Debit means left and credit means right. Okay. Um, we can see in this little diagram that for the assets on the left side, when they increase, that's what this up arrow means, you get a debit. And when an asset decreases, it's a credit. You can see the opposite is the case for liabilities, where if it increases, if you have a new loan or a new liability, it's going to be a credit. And uh, if it decreases when you pay off a loan, you would debit it. Okay. And the same thing with equity. So really, you can say that this whole side is debit and this whole side is credit. Okay, because when anything on this side increases, it's going to be a debit. When anything on this side increases, it's a credit. So this is actually related to the accounting equation. Okay, so I'm kind of writing it out here. I'm showing that on the assets, this is our this is the left side is the debit up, meaning that anything on the left side of this equation, if it's increasing, it's going to get a debit. And then on this side, anything that increases is going to get a credit. Okay. So it would be pretty straightforward, except we have a couple of things going on here. This, and these negative signs, right? So this liability, this contributed capital, revenue, they all follow this rule of increasing when there's a credit, or crediting when there's an increase. These two are actually the opposite because they're minus signs. So we can rearrange this. We can basically say assets plus expenses plus dividends equals liabilities plus contributed capital plus revenue. Right? I just added expenses and dividends to both sides, and that would cancel this out, and I moved it to this side. Right? So this is, I don't know, algebra, or I don't know when we learned this, like just messing with equations. All of these, when they increase, there's a debit. All of these, when they increase, there's a credit. This is how this system is arranged. Okay. So, for example, let's just do the example where my company is selling common stock to investors and getting cash. So is my cash going up or down after that transaction? Am I am I paying out cash or am I receiving cash from that transaction? Where my company is issuing stock, so investors are investing in my company. They're giving me cash, and my company is issuing stock to them. Cash is going up, right? So cash is what? What kind of account is it? It's an asset. So does that mean we debit it or credit it? Debit, okay? Because anything that's increasing on this side is a debit. So it'd be cash. Let's say it was like, I don't know, $1 million. Okay? So now what's the second account involved? Contributed capital, right? So when contributed capital, what side is it on? Is it on the debit side or the credit side? Credit side. So contributed capital, we have these new shares that are coming into existence. So that's an increase in the contributed capital. So that means that common stock is going up. Since it's on this side, it's going to be a credit of 1 million. So this is kind of the debit. This is the credit. We have kind of columns. Okay. So this transaction, it's following our two cardinal rules. There's at least two accounts involved, and the debits equal the credits. Do you agree with that? Okay. So this is the pattern of the whole rest of our accounting system. This is the system of debits and credits. Okay. So this table, it's the book just presents this as kind of like a table, okay, where uh, assets, when they increase, it's a debit, decrease, it's a credit, okay. But really, it's coming from this. It's essentially organized in the same way I just did it here. Okay, look, assets, expenses, and dividends all increase. All are debited when they increase. So let's just make sure that's the case. Assets, expenses, dividends, debit, debit, debit when they increase. Credit, credit, credit when they decrease. Liabilities, contributed capital, revenue, they all are credited when they increase. Liabilities, revenue, common stock, credit, 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 debit, debit, debit. So that's where this is coming from. Okay, so the table is there. If you memorize it, fine. but it's really just left and right. Okay, it's organizing this on the left side, credit normal on the right side, as we call it, credit normal, and it then puts these three here together and these three here together. So you're gonna get a lot of practice at this. Don't worry. Okay, so um, where do you hear? Okay, so let's just be clear on this. Where do we hear debit and credit in our lives? These words do exist. Where do you hear it usually? In what context? Credit card. Okay. What else? Debit card. Okay. Thanks. Yes. Very good. So, uh, what is the like? So when you look at your bank account statement, are you happy when you see a debit, or are you happy when you see a credit into your account? Who's absolutely confident that when their checking account, when you spend money, are they? Do you get a debit or do you get a credit? Debit, right? So maybe you think, oh, when my paycheck comes, I get a credit. That's good for me, right? So you may associate credit with good, or I get credit for my work, I get credit to my bank account. Uh, Really, this is a function of this system because what the bank is doing is that for them, your account is a liability, right? When you put money in a checking account, the bank owes you that money, right? They're borrowing from you. You put $1,000 in the bank, that bank is going to go loan it out to someone, but they owe you that money back, right? And they're paying you interest, if you have a savings account. So for them, what is that? Is that it's a liability. I just said it, so I won't ask you. So what happens when a liability increases? We just saw on this table, when a liability increases, it's a credit. And when it decreases, it's a debit. We agree? So when you go to your bank and you put in money, for them, that liability is increasing, right? It's a credit. In their accounting system, whatever, your account Patel, when I deposit money with them, what they're doing in their accounting system is that they're getting cash, whatever, $1,000, and then account Patel, which is a liability for them, is getting a credit. Okay, so when I get my bank account statement, and let's say I go to the ATM and I pull out $50 later. Okay, so let's say I did this on September 1, then on September 10, I go and I get cash out of the bank. Okay, my balance is going to go down, right? They no longer owe me as much money. So account Patel will get $50 of a debit because I, I've decreased the amount that they owe me because I'm taking money out, but they're losing cash. So they're gonna credit cash because cash is an asset, right? So we just saw here when an asset goes up, when they receive my money, they debited it. When they're giving me my money back as cash, they're gonna have to credit cash because they're taking cash from Bank of America and they're giving it to me. So their cash balance is going down. Okay? So at the end of the day, when they give me my account statement, they're going to just pull all the instances of account Patel showing up. This one, and they'll just say what was credited and what was debited. And so all the instances of me taking money out are debits, and all instances of me putting money in are credits. So it's really that whole debit and credit in your bank account is really just them tracking your account in their accounting system and then giving you the results. Okay, so there's no inherent good or bad. It's just good for us because when we put in money, we get a credit.